Edward Stevenson with TimelessWall.net, and this will be technical analysis on the Dow Jones Industrial Average. We'll break down the chart using daily and weekly intervals and see how those two charts fit into a long-term picture using the monthly chart. To begin with, on the daily chart we can identify several key supporting levels, one of which is 98.35, another at 96.80, and we'll just use horizontal lines indicating green to represent that. So as I mentioned, 96.80, and I'm just rounding up these numbers so that they're easier to remember. And of course, very significant one that occurred in the past few trading sessions, 97, we'll say 97.60 just to be rough. Let me just adjust that trend line. So all three supporting trend lines, very significant. Again, 96.80. 97.60 and 98.35. Then again, the past few trading sessions, the Dow has headed upwards, and we have another key supporting trend line at 10,120, and that's purely based on being formerly resistance back in this area when the price peaked, retraced, and then broke through that resisting trend line and headed upwards to what was nearly 11,300. On the resistance end, we have 10,240, which is primarily based on parabolic SAR and or the indicator that shows you whether the market's in an uptrend or downtrend, these trending white dots. Once the market breaks above it, it's by definition trending upwards in an uptrend, just as it was doing so right after this retracement here from 98.35 all the way to 11,200 plus points. Then we have the 200-day simple moving average, which is much less resistance than is an indicator of long-term growth. So we want the price trending above it, and that'll be a bullish signal. The fact that the price broke above the 10-day simple moving average, this blue line, currently at 10,063, shows that this market is in a state of momentum, at least on the short-term side, as it was during this period right here, where the price trended up beautifully and formed an uptrend. We also have the 200-day simple moving average coinciding with resistance just above it at 10,315, and that is based on this peak right here, where the price attempted to break to the upside but was unable to do so. So this remains rather critical resistance at this point in time. Then we have another former resisting level based on this channel back in November and or December of 2009, followed by 10,730, and that's this peak. So again, I'm using these horizontal lines depicted in red to represent resistance, the ones in green support, followed by this peak at 109.20, which poses resistance, although not as significant as some of these other levels. So we'll just indicate that with a dash line, and let me adjust that there. And the most significant one of all, I'm not even going to draw a trend line, so I'm just going to circle it. Of course, being 11258 or 11260, if that helps you better remember it. And now what I'm going to do is I'm going to flip over to the weekly chart and show you how some of these supporting and resisting levels are reflected on the weekly chart and why many of them are quite significant. One last thing before I do change over to the weekly chart, the volume here. I wanted to comment on the fact that we formed this nice candle coming off Thursday's trading session, showed a lot of encouraging signs. The fact that the bulls may have found a place in the market where they're comfortable buying and pushing it back up towards new highs. And this candle right here, which is typically a reversal signal after a short uptrend, any uptrend for that matter, hammer candle. And the least encouraging sign, as far as I'm concerned, the volume, it wasn't anywhere near above average or encouraging in terms of supporting the uptrend movement. So this was a sign of weakness, the fact that volume was significantly smaller than it was the prior few trading sessions when the price did decline. So this shows that maybe there's still some inconfidence in the market, but we'll take a look at the weekly chart to see what it has to say about volume and price relationships. Here we are with the weekly chart, which means now every candle and or bar represents 1 week worth of price action. The last one here representing last week's trading, let's put it that way. And we can see that the significant supporting levels here are very familiar to us because we did take note of them on the daily chart. So that's how the daily chart really fits into the weekly chart. 9775, we mentioned that being the low coming off of this period of retracement in the marketplace. 9835, we talked about that level as well. So let me just circle that here too. And then on the resisting end, we have 10,730, and we mentioned that was quite a key one coming off of a former peak. So just put in a trend line there. And you can see how beautifully this coincides with some of the trading candles right here, which represent the past few weeks worth of trading. And of course, the key one, 11,260, as well as the 10 MA, which would represent momentum on the weekly end. You know, not as significant in the weekly charts as it is in the daily. However, the 200-day simple moving average, you know, that's a mark that the market has struggled to stay above. Only 1 week was it that the market did trade above it, and that was this period right here. And you can see the very next week the market broke down below it again. So this is a very strong indication of long-term growth. We want to eventually break above 11,110, which is currently where the 200-day simple moving average trends. And the last bit of news that is encouraging on the weekly end, volume price relationship, we can see that we form a hammer-like candle suggesting that a reversal may be possible in the coming weeks. We would need to see this confirmed next week to more or less be certain that we do see movement to the upside, maybe an upward spiral. Hopefully that might be the case. And the volume, of course, that came in last week was encouraging, much larger than the week before. And you can see the volume settle over the past 3 weeks while the price retraced, which was a good sign if you're long in this market, just as much as this past week where the volume increased as did the price. And finally, the big picture, the monthly chart, where we have fairly recognizable supporting levels, one being the low that we talked about, 97.75, as well as that peak at 11,260. We can see that we have one very significant supporting trend line that has formed a channel over the years at 9,700. So just slightly below where the market fell and found supporting level. You know, which is not surprising. A lot of these trends do tend to repeat, and that's what technical traders essentially look for. And the peak at 11,300, again, not too surprising because of the fact that this looks right. The fact that, you know, we peaked over here many times in the late 90s and early 21st century, 2000, 2001. You can see the market struggled to break above that 11,300 level, and it did not do so up until late 2006, after which, of course, we know that we had the financial meltdown, the economic crisis, and the market just plummeted. But it's interesting how both the daily and weekly chart feed into the long-term picture. I'm using the monthly chart here, and it shows essentially growth over long term. We are trending above the 200-day, in this case the 200-month simple moving average, which is very essential. The fact that we are seeing long-term growth. Yes, we've retraced a good, let's say even 600, 700, 1,000 points, but now we're seeing a sign of reversal, which is encouraging. We need to break above this level and start testing highs at 13,000, 14,000. Who knows? Maybe we'll break past those resisting levels in the coming months, and we'll see another bull market, and leave all those who are saying that, you know, the bear market hasn't even reared its ugly face yet in the dust. But once again, this was analysis on the Dow Jones Industrial Average. If you have any questions, please feel free to contact me. Simply visit timelesswealth.net. and access our resources. Thank you for listening.